Rose. Brian Rose is senior U.S. economist at UBS Global Wealth Management. Brian, thank you a lot for joining us. Your take on these numbers. For the most part, they come in significantly stronger than expected.
Yeah, obviously that is a pretty strong number, a pretty big surprise to the upside. And importantly, the GDP has been growing faster than the Fed's estimate of the trend growth rate since the third quarter of 2022. So this is just another quarter where the economy is growing faster than what the Fed thinks is sustainable. So, if you're thinking about the timing of Fed rate cuts, it's hard for the Fed to start cutting if the economy is growing faster than their estimate of its potential.
Let's take a quick look at the U.S. futures to see how the stock market investors are reacting to these numbers. Again, growth, and there you have it, a markedly changed picture. Alan Small, what would your take be on that market reaction? The pre-market jumping, not hugely, but the tone distinctly positive after the release of those numbers.
I think good news is showing out to be good news, right? Normally we see good news is at times bad news. But I think the market's in a win-win situation. If we do see a slowdown in GDP, in growth, in the economy in general, I think the Fed will be forced to cut rates. And if the market continues on this pace, well, the Fed can delay that first rate cut, but the market will reflect the good growth numbers. So I think the market's in a win-win situation, and that's why we're seeing these markets go higher, even when the news is good or the news is bad.
Brian, when do you believe the U.S. Fed will cut its benchmark rate for the first time? The market currently believes that's May the 1st.
Yeah, this is our base case, is that the first cut will be in May. But of course, the Fed remains highly data dependent, so all depends on how the data comes in. Given how low the inflation data has been recently, the Fed is in a good position to start cutting if there's any sign of trouble in the economy. So especially if suddenly, for example, you have a bad payroll number, the Fed can just start cutting rates right away because they're not so concerned about the shorter term dynamics on inflation. But if we keep getting strong numbers, the labor market is strong, wage growth is strong, the economy is growing faster than potential, the timing of the rate cuts could be delayed substantially. So it could be second half of the year before the Fed can start cutting if the data is strong enough.
Brian, do you think that the Fed will want to get ahead of the situation, meaning cut way before or well before we see anywhere near a 2% inflation rate? I guess the question becomes, at what point, or we've obviously this quarter, we're seeing a slowdown from the previous quarter in terms of GDP. So at what point do they say, okay, things are slowing down significantly enough to cut rates, even though we're still seeing inflation above 3%?
Yeah, so the Fed has said that they're not waiting for the year-over-year inflation rate to hit the 2% target. The sense is that would be too late. If you wait that long, you're really risking the economy going into a recession. So the Fed sees its current policy stance as restrictive, which means that if they leave rates where they are, eventually the economy will slow down. And if you think just in terms of market pricing, the market's pricing in more than 100 basis points of rate cuts this year. If the Fed doesn't cut, financial conditions will tighten. So I think there's a strong consensus that the Fed will be cutting rates this year. It's just a question of when. And again, because the inflation data is so favorable, it changes the risk reward for the Fed. There's no sense in keeping policy too tight and risking a recession, given that the inflation is already running at a pace close to the Fed's target in terms of what we've seen over the last 6 months.
You've told us, Brian, that you expect the U.S. Fed to cut rates for the first time in May. How many rate cuts do you see in 2024, and by how far do you see the key lending rate declining?
So our base case is 100 basis points of cuts this year, but very easily could be more or less. And this isn't our base case. We expect a soft landing. But if the economy does turn downward, if we have a recession, the Fed's likely to cut rates very aggressively, again, because the inflation data is already favorable. If the economy goes into recession, you have absolutely nothing to worry about on the inflation side. No reason for the Fed not to cut aggressively in that case.
So do you, I guess, agree with my thought that the investor wins out either way, whether the economy stays strong and the Fed can hold off cutting rates, or whether the economy starts to slide and then the Fed, as you said, can aggressively cut rates because obviously the spread between the Fed rate and where inflation is sitting today, there's a bit of a buffer there. So do you agree that as an investor, you're kind of in a win-win situation?
So there is this sort of sense that we're in the Goldilocks scenario. The combination of growth and inflation has been more favorable than anyone was expecting. So yeah, that's I'd say is the good is because inflation has surprised to the downside. It gives the Fed a lot more flexibility to cut aggressively if there's bad news, and they also don't have to tighten. No matter how strong the economy is, they don't need to tighten further. So I think it is a good situation for markets. Again, more favorable than anyone was anticipating a year ago.
Brian.